You believe you own your assets, your stocks, your money in the bank, your digital coins. But ownership in modern finance is rarely what it appears to be. When you buy a stock, you don't receive a physical certificate. You don't hold it directly. It sits within layers of custodians, clearinghouses, and brokerage systems. Your name isn't always on the asset. It's recorded in a structure built for efficiency, but also for control. Banks operate on fractional reserves. Your deposits are liabilities on their balance sheet. The money you think is yours is simultaneously someone else's loan. Even in crypto, the industry built on self-custody, most participants leave assets on centralized exchanges. Convenience replaces control. History shows that during times of crisis, access can be restricted. Withdrawals paused, trading halted, accounts frozen. Not because markets failed, but because systems were designed with circuit breakers. Ownership in modern markets often means beneficial interest, not direct possession. The distinction matters, because when systems are stressed, priority goes to stability, not individual access. This isn't fear, it's structure. The financial world optimized for speed, liquidity, and scale. But every optimization carries trade-offs. And the question isn't whether the system works. It does. The real question is, do you understand the rules of ownership inside it? Because in modern finance, control doesn't always belong to the holder. Sometimes it belongs to the structure, and it's one of the most powerful words in modern society. Own a house, own stocks, own assets, own your future. We are taught that ownership equals security. But in modern finance, ownership is often an abstraction. When you buy a stock today, you don't receive a certificate with your name printed on it. You don't physically possess anything. Instead, your purchase moves through brokers, clearing firms, and central depositories. In the United States, most equities are ultimately registered under a single nominee name, Seed & Co. Your brokerage account reflects a balance. But legally, what you hold is a beneficial claim, not direct title. That distinction sounds technical until stress hits the system. Because the financial system is layered. You, broker, clearinghouse, depository, issuer. Each layer exists to improve efficiency, speed, and liquidity. But every layer also introduces dependency. You trust your broker. Your broker trusts the clearinghouse. The clearinghouse relies on capital buffers and systemic safeguards. It works until it doesn't. History provides examples. Trading halts during volatility spikes. Withdrawal limits during banking panics. Funds gated during liquidity crisis. Not because assets vanished, but because access was temporarily restricted. Access and ownership are not the same thing. Consider banks. When you deposit money, it is not stored in a vault with your name on it. It becomes a liability on the bank's balance sheet. The bank lends it, invests it, uses it. Your deposit is a claim, and in most cases, the system functions smoothly. But during stress, banks can limit withdrawals, because stability of the system takes priority over individual liquidity. Now consider retirement accounts. Your 401k or pension fund holds assets on your behalf, but you don't control the execution, custody, or structure. You hold exposure, not possession. Even real estate, the ultimate symbol of ownership, is often financed. The bank holds a lien. Mispayments and ownership becomes conditional. Now let's look at modern markets. Derivatives. Markets are many times larger than the underlying assets. Exposure is traded far more than physical ownership. Synthetic positions, options, swaps, leverage. In many cases, what moves markets isn't ownership of assets. It's exposure to price movement. We've built a system optimized for liquidity and scale. But liquidity requires centralization, and centralization introduces control points. In crypto, the promise was different. Self-custody, decentralization, permissionless ownership. Yet most participants store assets on centralized exchanges for convenience, for speed, for yield. And when those platforms collapse, as history has shown, ownership becomes a legal proceeding. Because if you do not control the private keys, you control access, not the asset. This isn't alarmism, it's architecture. Modern finance is not built around possession. It is built around claims. Claims that function efficiently in stable conditions. But claims depend on counterparties, and counterparties depend on solvency. During systemic stress, governments step in. Central banks inject liquidity. Authorities impose temporary freezes. Markets halt trading, all in the name of stability, because the system is designed to prevent collapse. But preventing collapse sometimes means limiting individual freedom. And here lies the paradox. The more efficient and liquid a system becomes, the more centralized its control points must be. Clearinghouses, central banks, custodians, regulators. They exist to reduce chaos. But they also define the boundaries of ownership. In normal times, you don't notice the structure. Your app shows balances, your portfolio grows, your transactions settle instantly. It feels seamless, invisible. But ownership in modern finance is layered, conditional, and structured. It is mediated by institutions, by contracts, by rules written long before you participated. This does not mean the system is broken. In many ways, it is remarkably resilient. But resilience comes from coordination, and coordination requires authority. The real risk isn't that you own nothing. It's that most people never question how ownership actually works. They assume control. They assume access. They assume permanence, until volatility exposes structure. Understanding ownership isn't about fear. It's about awareness. Direct registration versus street name. Custody versus self-custody. Assets versus derivatives. Exposure versus possession. These distinctions matter because in finance, the difference between control and claim is invisible until it isn't. And perhaps the most important question isn't, do I own this? But rather, who ultimately controls access to what I believe I own? In a world built on speed, leverage, and scale, ownership has evolved, not disappeared. Evolved. The system works, but it works on rules, and the more you understand those rules, the less illusion remains. Welcome to Cash and Chronicles, where money, power, and history collide.